All right, so we have Celtic Trader today. He's going to be going over his charting, technical analysis, day trading. I'm just going to be watching the Zoom because we're getting a few more members now as well. So, Celtic Trader, Aiden.
All right. Thank you, Lance. Good evening, everybody. So tonight, what I want to do is just give you guys an overview of the analysis that I typically go through when I chart, typically the night before and then the morning of, and just to kind of give you an idea as to how that methodology works. So first of all, thank you everyone for attending tonight. My name is Aiden, Celtic Trader in the Discord channels. Um, so what I'd like to talk about is the art of charting and technical analysis, and basically just discuss the system that I use. And it's a system that I've developed kind of over time, and it's grounded in copious amounts of hours of personal research. And when I mean copious, I mean a lot, just looking at different strategies and different traders and essentially trying to figure out what they're doing and almost like coming to a level of convergence where I kind of get what each of them are doing, and what I need to do is just kind of figure out something that works for me. So to begin with, let's kind of talk about price action and what that means. So price action provides most, if not all, the data that we need to trade. Price action tells us the story of what's happening in a security, be it Google, be it Meta, be it an ETF like SPY or QQQ in real time, what has happened in the past, and moreover, it gives us clues as to what could happen in the future. Now, sure, this can be supplemented with other processes like dark pools, heat maps, option flow prints. There's other techniques that you can use to supplement your trading. But the charts, they give us the structure of price action, and structure gives us the context. And once we have a context, then what we can do is we can draw what I like to call statistical inferences. And what do I mean by that? We're inferring on the future what we believe could happen based upon what's happened in the past. So, as we're navigating through this discussion tonight, I kind of want you to think of two things. Number one, structure, which gives us context, and number two, inference, which gives us actionable trades. So this is my world of technical analysis. So price action. Price action is history. And we all know with history, guys, that history is that on your side or
You guys can mute your screen, please, or if you're on mute.
oh, there we go. Perfect. Thanks, guys. So price action is history. And we all know with history, it can repeat itself, but not necessarily exactly, but it sure does rhyme. Now, I don't know if any of you guys have read the book called The Fourth Turning, which is a pivotal book that everybody really should read. It's by Neil Ho and William Strauss. And this book is eerie in how this paradigm of cycles repeating themselves hold true over time. And cycles, be they in history, be they in trading, are a function of human nature to a certain degree, and human nature is a function of how we are all intrinsically wired. Winston Churchill had a great quote a long time ago. He said, "The further you look back in time, the further forward you can see." So let's talk about the past, because that's what the charts are all about. We're studying the past first. And the first thing you should always do when you look at a chart is look at that chart raw. And what do I mean, look at that chart raw? Look at that chart unencumbered by trend lines, by support, by resistance, basically just candles. That's it. That's where you want to start. And when we start with a raw chart, that's when we can begin the journey of technical analysis. Now, the first thing that we want to draw on a raw chart are levels of support and resistance. And what are levels of support and resistance? Well, the more candles on a chart that converge at a horizontal level or a horizontal range, the more powerful that level becomes. So, for example, if you have a chart with 10 touches, price action touches a certain level or a certain range 10 times, that carries a lot more weight than if it just touched it 2 times. Here's a chart of Google. So this is a raw chart of Google over the last 6 months on the 4 hour. So if you look at this chart of Google, we've got no indicators up there, and you can tell just looking left to right that this chart is a bullish chart. And if you look towards the tail end of it, we had a big breakout on Google. I think that had to do something with possibly the Chrome browser. I can't remember exactly what the news was. So anyways, we have our raw chart. And the first task at hand that we should do is go ahead and mark support and resistance. So, for example, if you're coming along here, you would mark this area right here to encapsulate this region and this region. And you would come up here and you're looking at a level right here again. You come up here, you're looking at a level here. You're looking at a level here. You're looking at a level here. And then actually over here, this is quite significant because this occurred back in time. But if you connect this here to over here, you can see that now we're getting to a real significance level. So this is an area of resistance. And it's an area of resistance that is kind of a touch and go for a period of time before it kind of breaks down. And then it starts to come back up again. And then it breaks and starts to oscillate around it. And then it breaks out. And then as you can see, it breaks out significantly. So that's the raw chart. And then these are a couple of levels that I just added based upon what I just spoke about. So when drawing support or resistance, what I like to do is I like to draw rectangles to encapsulate price range of interest. And what I like to do is I like to capture as much of the candles and their wicks from left to right with newer support and resist patterns having a shorter span. What do I mean by that? So if you look right over here at this part of the chart, notice that this level of well, it was resistance and then it became support, but it kind of begins here because if I trace all the way over here, there's almost like a kind of a gap down or there's a big displacement candle. So I'm just kind of looking here from left to right. But if I look at this one up on top, you can see that I can connect, this region over here with this region over here. So remember, the more candles we capture, the better. All right, so now we started with a raw chart. Now we have levels of support and levels of resistance. And by the way, we're on the 4-hour chart here, going back 180 days. Okay, so every day basically has 6 periods, and then take 6 and multiply it by 180, and you get the cumulative total there, which I believe is 600 plus 480, so 1,080 data points, which is pretty significant. Anyways, this is the 4-hour chart I like. You can also use the daily as well too. Okay, so before we continue just looking at Google's chart, let's talk about trends and what makes a trend. So there's 2 types of trends that we can have. There's uptrends and there's downtrends. And uptrends are characterized by a series of higher highs and higher lows. So you'll notice that price comes up, it comes back down, and then it comes up, it makes a higher high, and then it starts to come back a little bit to pull back, and then it repeats the cycle again. So you'll notice a series of higher highs and a series of higher lows. So when you have a pattern like this is a good pattern. This is a bullish pattern. This is something that's in play that you want to be trading. And then conversely, you have a downtrend. And downtrends are characterized by a series of lower lows. So lower low, lower low, lower low, lower high, lower high, lower high. And then we have range, chop chop. And these are the 3 types of price action that we're presented with. Now, I like to day trade, so I try to avoid this as much as possible, unless if I've studied the charts pre-market, and if my analysis is kind of like correlated maybe with Lance's, which it typically does, that's when I might put on an iron condor. And an iron condor is great for trading chop. And Lance, I'll let you talk about that maybe later after the presentation. Yeah.
Sounds good.
Okay. So I like to avoid this. And the reason why I like to avoid this is because think about this logically for a moment. You have a top and you have a bottom. And most people usually typically are trading in the middle. And the problem with trading with the middle is, let's say you're here and price is going down. You're like, okay, I think it's going to keep going down. And then it keeps going down, and before you know it, it wicks you back up. And then you're out of the trade. Or, let's say you're up here and you believe it's going up, and then it wicks you back down. Now, the only thing that I could say maybe as a a variation upon this topic is if you have a wide range, what you could do is you could potentially trade the top of the range for a short or a put, and you could trade the bottom of the range for a call um, and for a long. But you do not want to be trading in the middle here. You trade in the middle here, it will typically chop you up. Yeah. Okay. So when you have a tight range like this you really want to avoid this. And I'll let Lance talk about Arnie Condors later on, but this is a good strategy when you have something like this. Okay. So what I like to do is I like to trade with bias. And what I mean by bias is we have a trend. And moreover, what do I mean by bias? We have SPY, we have QQQ breaking out of a range, breaking out of, we'll talk about the levels in a moment, previous day high, breaking out of previous day low. If you guys go back to what we had last Friday, that was a great day of trading. Today, it was not the best because there was a lot of chop chop, even though the indications early were possibly that we could have a bullish trade, but it changed in New York. And Friday was much better. Even Thursday was bullish, Friday was bearish. And then Monday today was a little bullish, and then it went chop chop, and then it went bearish. Okay. There's a great quote from Gerald Celente. I don't know if you guys know him or not. He's the publisher of Trends Magazine. And he has a great quote that he usually talks, he mentions a lot. He said, trends are born, they grow, they mature, they reach old age, and then they die. So trading with directional bias can be powerful. So if you just started trading Google here, all the way up here. So if you look at Google here, this again, we're on the 4-hour chart. Do you notice that I'm highlighting all the higher lows? So higher low, higher low, higher low, higher low, higher low, a little higher low here, higher low, higher low, higher low. So that's the first thing that I'm looking at is looking at all of these kind of pivot points, if you want to call them that, all the higher lows. And then additionally, I want to start identifying all the higher highs. So, one here, 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 one here. And once I do that, now what I can do is I can connect two lines here on the 4-hour chart, and these lines are in green. I kind of have a color coding scheme. There is kind of a method to my madness, but this lower line here is a trend line that's connecting all the higher lows. And then this trend line here is a trend line connecting all the higher highs. And you may say, well, Aiden, why are you doing that? Well, I'm doing that because it's giving me an idea where price action is going. But moreover, it's also telling me when I'm reaching the top of, like if you look at these two lines, it's almost as if they're parallel lines. Remember, parallel lines have the same slope. Now, these lines are not exactly 100% parallel, but they're somewhat parallel. And it's kind of interesting because if you think about this almost esoterically, you could say, well, is that by design that this is happening? Is there, we're just looking at charts here, but there's actually a pattern that's emerging. And is that by design? So these are the questions that you need to ask yourself. Is this happening by design? So here we have a lower trend line and an upper trend line, one connecting all the higher lows, one connecting all the higher highs. And then what we can actually do is we can watch as price action behaves here. So here, for example, we would have had a day where it bounced off the top of the channel and, we would have been in bearish land. So you could have on the 4-hour chart, and if you zoom down to the 1-hour chart, you could see that we were rejecting at the top of this 4-hour bullish. And if you went down to the 1-hour, you could see that's what I'm seeing on the 4-hour as well. And if you jump down to the 15, you can see, oh, maybe now I have a play for Google on this particular day. And look, it jumped quite significantly. So that would have been a great day to trade. Look at this day over here. Not so good right here, guys. This is chop, chop, chop. And also, moreover, do you notice that it's right in the middle between the upper and the lower? So chop, chop, chop here. And then if you come over here again, look at this this day here where boom, it's just like big displacement. And not only that, but look where it went all the way down to. It went all the way down to an area of a horizontal area of support, and it bounced right off the trend line. So, when you're drawing trend lines on the 4-hour chart, try to draw trend lines connecting as many ovals or as many higher lows and higher highs as you can. If you guys remember the concept of collinearity from geometry, collinear means points that lie on the same line. And that's what you want to be doing, is you want to be drawing trend lines with with as many collinear points as possible on the low end of the channel and likewise on the top end of the channel. Okay, so this is the view from like 20,000 feet or 30,000 feet. It kind of gives us a lay of the land as we're on the airplane looking at the landscape below. Okay. Now, let's talk about what I like to call consolidation or chop. And I actually got caught up in chop today. And sometimes I see it and sometimes I don't see it. And you know, when you do a postmortem, you're like, oh my God, that was chop. What the hell was I doing trading that? But you learn, you learn your mistakes, you go back to the charts, and then hopefully you can come to a period of time again where you see this and you'll be able to spot it. That's easier said than done, but this is what experience does usually over time. Now, this region here that's in the yellow, this is going to be a resting region. And what I mean by a resting region, so look at price here. Price came up from the higher low, and then it came into this region here. And this is kind of a region of support here because if you draw a level of support here, do you notice that we're connecting several wicks here, and we connect them right here again. But do you notice that price action is it's consolidating here? Yes, it does break out, and then it goes up to another area, and then it comes down and it comes back down again. So there's a lot of chop here. You could actually even draw this yellow rectangle to encapsulate even these two right here. But again, I like to draw rectangles almost in between levels because the levels are important. The levels are always important, first and foremost, especially on the higher time frame charts, levels of support and levels of resistance. Yeah. So then as we kind of navigate up here again, do you notice that we come back here and then we have a lot of chop here again? So this is going to be consolidation. And if you look at this one right here, this consolidation on Google, it went on for several days before it broke out. And this is an important concept that you need to remember is that price action can get into this consolidation phase. And this consolidation phase can last for a period of time. But basically what happens is it builds up energy. The longer it's in this type of tight channel and the more coiling that's going on. Think of your physics classes that you took at school where you have a spring and you're coiling a spring and you're building up all the energy in the string. And now it's hard to turn the lever on the spring and it's building up this elastic energy. And then eventually it has to release that energy. And as you can see, it did that. Obviously, this is rather dramatic here. Usually what happens is it just, pops up like this. And we'll talk about that when we go over the second part of the strategy, which are the scalping strategies. Okay, so this is potentially a good stock to trade as a bullish setup. Now let's take a look at Lulu. So if you look at Lulu, Lulu is clearly in a downtrend, and it's characterized again by lower lows. So lower low here, lower low here, lower low here, lower lower here, lower high, lower high, lower high. And again, the pattern is almost, if you kind of think of wave theory, it comes down like this, it comes back up, and then it comes back down again. Now, this line that I drew down here, this is what we call a bear flag. And what do I mean by a bear flag? A bear flag is where you're connecting a displacement down with a pullback. And usually what you're expecting is the pullback tends to rise. And again, notice the way we're drawing parallel channels. I mean, if I go to the next screen, this guy's is what I was doing at the 4 hour. And if I go back to the previous screen, so this here is a reflection of what's going on again on a 4 hour. But if I zoom back out and I look at the graph in its entirety, I can see that this is the development of a bear flag. And what am I expecting after that? I'm expecting this to break down, and that's exactly what it did. Now, is that always guaranteed to happen? No. It could consolidate for a long period of time, and then it could go back up again. There are no certainties. There are only probabilities. But what we try to do is we try to recognize patterns. And I'll go over a couple of the patterns that I got as a cheat sheet from TradingView, and we'll talk about those in a minute. So this is a bear flag on Lulu. So one example with Google is a bullish trend, and one example with Lulu is a bearish trend. Okay. So trends move in a direction over time. They move either higher or they move lower. They consolidate and they rest, like I discussed, before continuing the next move in a defined direction. And that keeps going on until it doesn't. So trends, be they on any time frame. So if you're looking at the 1 hour, you're looking at the 4 hour, you're looking at the 1 hour, or sorry, the daily, the 4 hour, the 1 hour, the 15 minute, the 5 minute. Um, Trends can change direction anytime, and they can break character. Now, what do I mean by break character? Well, some traders call it a change of character. And what a change of character is basically this, where you have a series of high lows. So one, two, and by the way, this is where we have a bullish trade. So we have higher low, higher low, higher high, and higher high. And now, do you notice the pullback here? This pivot point right here, this lower low, is lower than this higher low. And then it comes back up again, and this lower high is lower than this higher high. And now it breaks. And when it breaks, well, first of all, your spidey senses should be on alert right here when this happens. And when this happens as well as a secondary confirmation signal, now your spidey senses should be alerted big time. And then, of course, the yellow alert and the red alerts will be going off once this changes, because now you have a change of character. In other words, the trend was born, it grew, it matured, and now it died by means of a reversal. Okay, so let's talk about patterns, because these are really, really important. Now, I already spoke about the bear flag pattern. And with the bear flag pattern, what you're going to have is you're going to have a security, an ETF, whatever it is you're trading, futures, it doesn't really matter, crypto. You have price action coming down, and it's coming back to retrace, and it's consolidating in a very defined parallel channel here. Almost, it doesn't have to be parallel, but this is what we call a bearish flag. And usually with a bearish flag, the expectation is that this is going to break. And when it does break, that's a powerful signal. So that's when you can get in for a breakout trade. Or it can break out and it can come back and retest, and then you can wait for a confirmation candle going down again. That's another way you can trade this. This is the bullish flag. I think I drew this in the room for Urban Organics earlier today. I was looking at a break. Actually, I was looking at a break on SPY today, and it pierced the lower end of the channel. And I think Urban Organics took the trade on the lower end of the channel, and that's what I should have done. But I was actually waiting for a break on the higher end of the bull flag, and I actually took it. I got a really good entry, and it started running, and I was like, okay, this is looking good. I'm actually reasonably comfortable about this. One thing that I didn't do, guys, was I didn't look left enough, because when I looked left enough, there was kind of a level of resistance there. And I actually thought we would have enough momentum to continue in this trade. So I didn't scalp it. I was going to lotto it. And boy, did that burn me, because I got a massive displacement candle. And yeah, that destroyed that trade. So we'll talk about scalping strategies a little bit later. But anyways, bear flag and bull flag, you always have to be drawing these when you're day trading, especially when trends are in motion, because it's a validation and it's a confirmation when you get signals like this that the trend is continuing. Okay, now another type of structure that presents itself, or pattern that presents itself, is what we call like a consolidating channel. So you could have a bearish trend that comes down and it consolidates, and then it continues. Or conversely, you could have a bullish signal, comes up, it consolidates, and then it continues. Ultimately, what we're trying to do here is we're in a consolidation range, or what I like to call a squeeze. And when we get in a squeeze, we get back to this concept again of coiling, of elastic energy, of a buildup of energy. And this can go on for a period of time. But eventually what happens is it breaks, and it breaks either down or up. And we'll talk about scalping, how to try and scalp that. There's different strategies. Again, you can scalp the breakout candle when it manifests itself. Or if you miss that and it breaks out and it comes back up to retest and then breaks down again, you could grab that as what we call a break and retest. Anyways, these three are important. Now, the pennant is interesting. And with a pennant, basically what you're seeing is you're seeing price action attenuate. And what I mean by attenuate is that the range is compressing. And when it compresses, again, this is building up energy, and it's going to release in one way or the other. Now, these ones here are some of my favorite. These are what we call the reversals. And this is what we call a double top. And a double top is where you've got price action reaches this peak, and it comes back up to reach the same level again, but rejects. And you can actually, double tops usually are good to trade. Triple tops sometimes are good to trade. If you get a quadruple top, it's likely you might get a breakout. But these present themselves um, day trading, just like a double bottom. A double bottom is the converse of a double top. A double top is a short. Um, a double bottom is a bullish trade. Now, where would you take entry here? Well, you would take entry here where, in the case of a double bottom, if price action touches and it reverses, with a strong bullish reversal candle, then you can get in here and you can set your stop loss just slightly below um, the level of support here, and then conversely up here for the double top. Now, why would you enter right here? Well, if you capture this, think about this from an optimization perspective. You're getting in right here, and you're only risking a certain amount. And if you have a target going all the way up to the neckline here, or even all the way up to this level here, wow, boy, that's good risk and reward. Now, so double top, double bottom. Now, these are patterns that have been manifesting themselves in SPY. These are what we call head and shoulders. The one that we're dealing with in SPY a lot is the this one right here, the one on the right. The one on the right is what we call an inverse head and shoulders. And an inverse head and shoulders is a bullish pattern. So here you've got the left shoulder, you got the right shoulder, you got the head. And basically what happens is price action comes down to the head, it comes back up, and then it comes down almost like to the shoulder region again, and then it breaks and it goes back up. And then this is the bearish pattern as well. So these two are important to recognize. You see these a lot on SPY. The one that I really, really like is the cup and handle, because the cup, like this guy right here, this bullish or inverted head and shoulders, this can morph into this. Sometimes you actually see a cup and handle developing, and a cup and handle is a good bullish pattern. And how can I describe this? Well, I can describe, imagine you had a cup in front of you, you're drinking your cup of coffee or your cup of tea, and there's a little the little loop that extends out of the cup. So this is like kind of a big parabola, and then we have a little parabola that just kind of runs right off of that the holding area of a cup. And then this, if you draw a trend line here, this is a bullish pattern that continues up, and then this is the reverse. So these ones here are the ones that you really want to try and read in a chart, along with this, and this. Now, these are special as well, too. I don't really get into these two right here, but the wedges are important. We actually, in SPY right now, we have an ascending wedge on the 4-hour chart. And if I have a chance later, I'll show you that on Thinkorswim. Let me see if I can you guys see my Thinkorswim there by any chance?
It's not up yet.
It's not up. Okay, let me just
No, it's still the presentation.
okay, just one moment. Let me put up Thinkorswim so I can show you what I'm talking about here. All right, do you guys see that there?
Yeah, it came up.
Okay, so if you look at this right here, so this was SPY back in April, and here again we're connecting higher lows, higher lows, higher lows, higher lows, and that trend line and this trend line right here, they converged. You see the way these guys converged, and then eventually it broke out, and it broke out along this area right here. But if you connect this all the way up to here, and you connect this up to here, this is almost another representation of this, but not with as wide a bandwidth. So these type of ascending wedge patterns, usually what happens is you have a buildup of energy, buildup of energy, buildup of energy, and then typically it breaks out of that pattern. Okay, let me go back to the presentation again. Okay.
All right, we see it.
All right, so these patterns are important, guys. The bearish flag, the bullish flag, the channel flag, and then these reversal patterns right here. I don't really get into these neutral patterns much. I'm looking for continuation. I'm always looking for continuation, and I'm looking for squeeze, ascending and descending channels, and then I'm looking for reversals. These are the ones that I'm looking at, and this is, if you want to really start to get, a little more adept at price action, take a raw chart and see if you can identify these on a 4-hour chart over a 1-hour chart, and you'll see these patterns emerging in one shape or another. Okay, So let me talk a little bit about the system that I use. So I mentioned at the outset, at the beginning, that there are two parts to the system that I use. The first involves filling in the details on a raw chart on a higher time frame. So the daily, the 4 hour, and the 1 hour. Those are from my perspective, those are the higher time frames. And what do? I go usually to the 4 hour and I'm adding my levels of support and resistance there. I'm adding my trend lines there. And then I'm identifying these chart structures, these patterns that we just mentioned in the previous slide, double top, double bottoms, cup and handles, head and shoulders, things of that nature, consolidation. I'm doing all that from 30,000 feet from the 4 hour view. Um, and then what I do is I go down to the 30-day 1 hour and I take a look at the 30-day 1 hour to make sure that it's reaffirming what I'm seeing at the 4 hour. And if I have to, tweak the trend lines a little bit just so, the points of concurrency are lining up a lot more, I'll do that. But typically I usually will leave it at what I've identified at the 4 hour. So this is what I like to call the macro view. This is from 30,000 feet. So once I've done that, then what I do is I jump down to the 15-minute level and I actually repeat the same exercise. And I do it at the 15-minute level where I'm basically looking for trends. I'm looking for patterns. I'm repeating the same exercise that I just did at the macro level, but this time I'm doing it on a micro level. And when I'm graphing, I'm graphing. So if I'm graphing trend lines or I'm seeing patterns or things like that, especially trend lines, my trend lines will be in yellow on the 15-minute chart. On the 1 hour, the 4 hour, and the daily, bullish trend lines are in green, bearish trend lines are in red, and my levels are typically just drawn as horizontal rectangles. That's it. But when I jump down from 30,000 feet to like 10,000 feet to like 5,000 feet, like down to the 15-minute, I usually draw my trend lines down there in a different color to differentiate them from the higher level timeframes. And then the next thing that I do then is I'm looking at the 15-minute to see what possibly could happen for the day ahead. And I'm looking at this in the morning pre-market. And then once I see what might be happening at the 15-minute, then I go down to the 5-minute. And think of the 5-minute as the kind of the plane coming into land, surveying the runway below. So when we get to the 5-minute, that's kind of my terminal point at that point. Now, some people can day trade at the 3-minute and the 2-minute. And if you feel comfortable doing that, that's absolutely fantastic. Actually, sometimes if you're at the 5-minute and you're looking for an entry, it's actually sometimes even good to shoot down to the 3-minute or the 2-minute because there might be actually more granularity at the 2 and the 3-minute that's not presenting itself at the 5-minute. Maybe you'll get a better entry. So I use like the 8 EMA and the 20 EMA. What an EMA is, an EMA stands for exponential moving average. What a moving average is. So if you had a simple moving average and it's an 8-day or it's an 8-period simple moving average, what that means is you take price action over 8 periods, you add them all up, the close for those 8 particular data points, add them all up, you divide by 8. That's a simple moving average. An exponential moving average is similar, but it gives more credence and more weight to recent data points. And the recent data points, those are the ones that you're kind of looking at because those are the ones that could provide momentum to what's going to happen next. So I use the 8 EMA and I also use the 20 EMA. We'll get to that in a moment. Okay, so anyways, daily, 4 hour, 1 hour, that's the macro view. And then the 15 and the 5, that's the micro view. So when I get down to the 5-minute, I'm marking 4 key levels every day before the market opens. I'm marking the previous day high, and I do that in green. I'm marking the previous day low. I'm doing that in red. And you may say, well, why are you doing that? Well, I want to see, is price action in range? Meaning, is it encapsulated between the high and the low of the previous day? Because if it's in range, we could be consolidating, which means I have to go back up maybe to the 15 and back up to the 1 hour to see maybe it is consolidating. And we get into a situation like we had today where there was chop. Okay. So that's why it's important to highlight these levels so you can figure out if you're in range or you're out of range. Now, I also like to mark the previous market or the overnight low and the overnight high because these can also kind of give us an indication as to, if we've moved either up or down, how extended was the move? And also, when the market opens, is the price action kind of correlating with what happened pre-market as well. So that's kind of an important consideration. So those four levels are important. I mean, previous day high, previous day low, carry more credence and more weight because there was more volume, and that was during a regular trading session. Whereas the overnight activity was not market. It was overnight activity versus market activity. But all four levels are important. Okay. So as I mentioned, if we're within range between previous day low and previous day high, then the question you have to ask yourself is when the market opens, do we have like what's our range? So if we're on SPY, do we have 2 points of range? Do we have 3 points of range? Do we have 5 points? 5 points of range is good because now we got some wiggle room. If we've got 1 point of range, yeah, we're not trading that till we get out of that range. Okay. So attenuation is important on range. So this is why we mark these levels. And I call this chop chop. And then when we break out of previous day low or previous day high and we have directional buys, I call that chop suey. And Friday, when we were trading SPY on Friday, that was phenomenal chop suey. I think I might have that chart in the presentation. We can talk about it in a moment. Okay. So okay. Now I have Thinkorswim scripts for previous day high, previous day low, and pre-market high, pre-market low. So if you guys need those for TOS, just hit me up and I'll create share links for those. And there's actually indicators on TradingView that you can find for those. Okay, so the first part of this discussion then was on structure. I remember what I said about structure. Structure gives us context. Structure gives us context. The second part then to the process that I use is what I like to call inference, identifying use cases to trade. So before we discuss use cases, we have to discuss candlesticks because candlesticks are price action in its purest form. Okay. All right, we just move to the next slide. Can you guys see that okay? Okay. All right. Can you see the screen there for the candles? Just double checking.
We just see your PowerPoint.
Okay. So do you see the PowerPoint that says candles?
It just says assuming
No.
use of day trade.
Oh, okay. Sorry about that. Let me just,
If you go to slide 18, I think that shows the candles.
yeah, okay.
Yeah, there.
There we go. Do you guys see that?
Yes.
Sorry about that. Okay. So
Yep.
so this is price action. Price action are candles. Now what do we mean? What are we looking for with candles? With a bullish candle, we're looking for where the candle opened and where the candle closed. The low of the candle and the high of the candle. And the body of the candle. Now, the body of the candle is important because the larger the displacement of that candle, the more significant that candle is. Now, you also want to be mindful of the wicks as well. Don't ever forget about the wicks because the wicks are telling a story. I mean, price action got pushed up here, ultimately got closed here. I mean, and if you look at the bearish scenario here, price action opened here, it closed down here, but in between, it went all the way to a low here, all the way to a high before coming back to close. So the wicks actually do tell a story. Engulfing candles. Now these, when you're day trading, you always have to pay attention to engulfing candles. So let's say, for example, you had a bearish play that was going on, and now you get this candle right here that's presenting itself. And this candle is a hammer candle. Yeah. And it's actually indicative that that price action is still bearish. But now suddenly you get a massive candle that completely engulfs not just that, but maybe a series of previous candles. When you have a candle, an engulfing candle that knocks out a series of previous candles, that's powerful. So now you could have a reversal that's going in play. Ultimately, it's nice if you're going to take a trade here for this to pull back a little bit and maybe you have a stop loss that maybe this is not going to reverse itself because sometimes it can do that. We'll talk about reversals in a moment. But anyways, this is that bearish engulfing candle, which is the opposite of this. Okay. The hammer candle is important, and the hammer candle can actually signal to us that we have a reversal in play. So if you notice with this, we actually have a bearish candle, but it's actually price action got pushed all the way up on up to here, yeah. But you notice that there's no wicks here. So anytime I ever see this candle here, that's an indication that we may have a reversal. It's not an indication that we will have a reversal. It's an indication that we could have a reversal. So what does that mean? I'm looking for the next candle or the next candle after that to see if that indeed is the case. And then
Um,
we have another. Go
Aiden,
go
could
ahead.
I just add a little bit here?
Sure.
So, I did mention in the chat a book that's really good on these candles. Um, you want to think about the buyers and sellers for that hammer. So, at the top, we were at the open, we were at the top of that candle where your crossbar is. And then at some point during that candle, it went down to that low, which means that sellers are in control at that point. But then we went up to the close right here, and that means the buyers are trying to fight back. However, it was still more sellers in control. So you always want to think about, are the buyers or sellers in control of a specific candle? And then you'll probably talk this similar with the doji as well.
Mm,
But you also want to combine multiple candles and see. That's why I would highly recommend the book I posted. I think it's Anna Cooling. Yeah, price action analysis. It's really good, and it's a pretty straightforward book if you haven't read it yet.
okay, that's good to know, Lance. Good to know. All right. The other candle then is that I'm always looking out for is a doji candle. And a doji candle is an indecision candle, meaning price action wicked up here, it wicked down here, and ultimately we've reached an equilibrium point. There's a battle going on between the buyers and the sellers, and we're at an equilibrium point as to what's going to happen next. Now, I mean, price action could continue bearish, but it could actually reverse as well. So this is where you want to be looking at ensuing candles to see if there's some type of reversal pattern in play. Again, there's no certainties, there are only probabilities. But one thing with the candles is, if you start to kind of appreciate the candles, and that book that you mentioned, Lance, is probably something that I'll try to pick up and read myself. But raw price action, if you take away all your indicators and moving averages, all that stuff, and you just look at the candles do tell a story. They tell a story in concert with volume, in concert with volume. Okay.
Yeah,
Now,
definitely consider volume with this as well. And the book I've mentioned talks about that a lot.
yeah. Okay, so this is kind of like the first part that I spoke about was basically structure and context. That's the first part. Now, so we went from the daily to the 4 hour to the 1 hour. That's the macro view. And then we shot down to the 15-minute and the 5 minute. That's the micro view. And we have everything on the 15 and the 5. We have our trend lines in yellow. And everything that's above in the 1 hour, the 4 hour, and the daily, all that's marked in green and red as far as trend lines. The levels of support and resistance, they remain on the charts regardless of what level that you're on. Okay, so let's talk about scalping strategies, how we can scalp. Okay. So the art of inference. I like to call this the inference part because we've set up our structure, we have a context, and now what we're trying to do is we're trying to infer what we believe could happen. I mean, there's no guarantee that it will happen, but this is the art of inference. Okay, so the first use case I want to talk about is what we call the breakout of the 15-minute opening range. ORB stands for opening range or the open range breakout. Now, this is a common scalp on the 5-minute chart. Those of you that use the 2-minute chart, it doesn't really matter. And it presents itself after the first 15 minutes of trading since market open at 9:30 a.m. It actually presented itself this morning. I scalped it. I think I scalped $5. I know you guys are laughing at me. I scalped $5, I think, in 4 seconds. So basically, the idea behind this is as follows, is you have price action that's in range between the opening range high and the opening range low, the 15-minute opening range. And then what's happening now is price action is starting to tease the low level here. It's starting to tease. Sometimes it teases a lot and sometimes it hovers a lot. Now, when you're in a situation like this is what I like to call wickery. And there's another word I won't mention here. It's a bad word. But basically, when you see something like this, and it's kind of like, wicking around here, I'm not taking that. I want to see a breakout, and I want to see it with velocity and with acceleration. So if I see that we're right at the bottom here and it's suddenly moving with gusto and momentum, boom, I have, right on my active trader, I have my mouse ready. I'm ready to click this and boom, I'm in at market, whatever it is. And then basically, if it displaces, 0.20, 0.30, 0.40, if I see this move quickly, boom, I'm out. And if I can grab, if you think about this logically for a moment, if you're using an at the money put in this case, so let's say the at the money delta is 50 cents per dollar move. And, one thing that you got to consider as well, too, is when you have movement like this, that's when gamma moves. Okay. So let's say, for example, there's a move of 0.30, and this happens like super quick. 0.30 times 0.5 is $15, and that can manifest itself very quickly. If it moves 0.4, $20. And then if you take gamma consideration into play, that could be instead of 15, 17, instead of 20, maybe 21, 22. The point that I want to try and make to you guys about this is don't be greedy on this. If you have a move and you get in, you see that move, it's almost like you're driving and a deer comes out in front of you and boom, you have to react to that ASAP. It's something that presents itself and it moves just like that. And you have to click just like that. And then you have to grab as much of it as possible. So this is what this is a breakout scalp. And we had one on Friday, and boy, it did it run, Okay, so that's that. But sometimes you can get in and it can oscillate. It can, like, there's wickery going on again. And I'm looking at that. And if that kind of displaces back up into the orb channel again, I'm out, because that means it violated the momentum principle that I'm looking for a momentum here. And if I don't get momentum, I'm not interested. Now, if I get out and there's a loss on that, so be it. If it breaks down again, I can come back and wait for what we call the break and retest. And that's going to be the second one that we have here. Actually, but before I talk about that, this was Friday, guys. Today's 9/8, so 7/9/6, 9/5. This was September 5th. And these lines here, these dashed white lines, are the opening range. And what was really, really interesting about this particular situation is this green line right here was a 4-hour green line that got broke. Powerful, powerful signal. So, there's credence to the lower orb level getting broke, but the fact that the trend line is getting broke in concert with that is providing an extra degree of convergence. So I scalped this. This was my first scalp on Friday, and I got a nice scalp on that. I can't remember exactly what it was, but so that was my first one. Now, price action came back up, and the next thing that I'm looking at right here is what we call a break and a retest, meaning that price action is pushing right up here. And as soon as it started to touch here and reject, then I was in again and I scalped. I didn't scalp all the candle. I just scalped a certain percentage of the candle. Here was another one that I took, and this one was close to the 80 and 8. I scalped a certain amount of that candle. Now, you could say, well, okay, so clearly we've got a breakout that's going on here. Why not just do a lotto? And actually, there's nothing wrong with doing a lotto. You could have just got in here around this area, put your stop loss right back inside the orb again. So maybe you've got 20 cents or so that you're playing as a stop loss. And then you could have a target here. This one here was a dark pool, but you could have had the target down here for the dark pool. Look at the risk to reward right here. You're risking 20 to make what, but 2020 in hindsight is easier said than done. I like to scalp candles if I can, and then if I feel confident that I'll do a lotto trade, I'll do the lotto trade. But if you did the lotto trade here on Friday, look at that just ran. But instead, I was just scalping. Okay. So that was use case 1, the breakout. Use case number 2 then is what I like to call the squeeze breakout scalp. And the squeeze breakout scalp is where you've consolidation that's going on between a level of resistance and a level of support. And this has been going on for a period of time. And actually, Sir Goldman, I believe, I wasn't sure whether, I think it might have been Thursday at around 3:30. He actually took a trade here that was so price action had been bearish, I believe, and then it was consolidating, and then boom, there was a momentum candle that presented itself, and he entered, I believe, um, either shortly after the momentum candle, probably stop loss just right below maybe 1/3 into the into the channel here, and then he had a target, and that ran. And that ran. So these present themselves as well too. Obviously, going up and also going down. Okay, so that's another one. This one is probably one of my favorite ones. This I call the break and retest, and I kind of gave you guys an idea as to a break and retest that I took on Friday. But a break and retest is where, again, you've got this type of kind of almost like coiling back and forth. It's like oscillate. It's like almost like a sine wave that's oscillating. And then what happens is it breaks out. So again, this is like the breakout scalp. But let's say you miss the breakout scalp. So I usually like to grab the breakout scalp if I can get it. But let's say you miss the breakout scalp and now price starts to come back and it starts to touch just slightly above the top of the breakout channel. And then what you're noticing thereafter is you're getting a confirmation candle, in this case, a bullish one, that you've had a touch and now you had a break and a reset and now a confirmation candle. So if I have a confirmation candle that I got on the 5-minute, what I'll do is I'll enter right here. I'll put my stop loss again, maybe 1/3 into the squeeze channel, and then I'll try and lotto this. So I could do something like a two target. I did something like this today, where I think I got in at one level and I targeted maybe about 15 cents. And then just as I was about to move my runner up, I got a reversal candle. And again, these things happen. It's just the nature. But you could target even two levels here. Let's say you were really comfortable with the price action at this point. Well, you could target maybe previous high of day. So let's say you got in right here. You could target PHOD, previous high day right here. And let's say there was another level of resistance up here. You could have a second target that you could do. But again, when you're day trading, single lots are usually the best thing to do when you're starting out, because if you can get comfortable with these type of use cases as they present themselves, over time, you'll recognize them more readily, and then you'll feel more comfortable with them, and then you can do variations like on a break and retest. Instead of like having one target, you can have two targets, maybe even three targets. That's a more nuanced and complex topic. But anyways, break and retest. That's that. Okay. So this is an example. I believe this was from Thursday, if I'm not mistaken. Yeah, I think this was a trade that Phil and I were in the Discord on Thursday, a 6:45 call, maybe, if I'm not mistaken. Yeah, so again, this was kind of our level, sorry, excuse me, this was our support area. This got broken out. And again, this is kind of our consolidating channel right here. So we got a breakout here. It came back, it retested, and I think I might have gotten in right here on this bullish candle right here. Stop loss again, and then target. You can set your target to what you want. Our target, I think, was maybe 646 on that day, maybe a little above 646. Yeah, I think it was around 646, and that actually played out. Now, the only thing I have to mention about this is this might have been later in the day, and one thing about trading after 11 o'clock is these 0 DTEs decay. And if it's not as accentuated at 11 o'clock as it is at 1 o'clock, 2 o'clock. So you don't want to be 0 DTE trading like in the afternoon at 1 or 2 o'clock, unless you do maybe credit spreads. But if you're buying 0 DTEs, you don't want to be doing that in the afternoon. You want to move to the +1. And the reason why is because these instruments start to decay rapidly, like really, really rapidly. But anyways, price action was kind of a little grinding here. And Phil and I were wondering, oh boy, is this going to play out? It actually did play out. We thought at one point, yeah, we got this candle right here. I don't know if you can see that. And this candle started to encroach just almost down to the stop loss, but it didn't touch it. And then it continued back up. Again, there are no certainties. There are only probabilities. Okay. The next type of scalping strategy that I'd like to do is what I call an EMA pullback strategy. And the one that I like is the 8 EMA pullback. So if you look at, we have a purple line here, and that purple line is the 8 EMA on the 5. The blue line are the teal line. I'm a little colorblind here. Maybe, no, I shouldn't say that, but I think that's teal, yeah, or blue. Um, so the purple is the 8, the blue is the 20, and this, yeah, I believe this might be the yeah, the white one is VWAP then. And I think these two guys might be yeah, no, yeah. This one that's on the outer might be the two standard deviation. But anyways, ignore all that. The one that you want to look at here is the purple one, which is the 8 EMA, and the light blue one here is the 20 EMA, and then the white one is VWAP. So with a pullback trade, guys, what I'm looking for is if we have if SPY is in play, and what I mean by in play is we have a directional buy, it's either bullish or bearish. Then what I'm looking for is I'm looking for a pullback to the 8. Okay, so in a particular situation here, if I had taken this trade right here, I probably would have placed the stop loss right down here, maybe to give it a little bit of wiggle room, just below the 20 EMA. And you can see here, it came down here and it almost like whipped it, but didn't touch it. And then it came back up and then it actually started to rise. But as you can see here, this is taking time. And again, this is a 5-minute chart. So I don't want to be in trades for more than 25 minutes. I want to be in trades, if it's less than 25 minutes is ideal. Scalping, I'm usually in and out, like pretty quick. Another possible entry here will be this one right here, where it touched reversed, and then you got the confirmation candle. You could get in here, and then look, it took 1, 2, 3, 4, 5 candles. And as this is moving on the trading ladder and on the option chart, you can start trailing. And this is one thing I want to mention is when you get a position that's profitable. So let's say you're into something and there's $15 of profit. You should be moving your stop loss. I know some people leave their stop loss, just want to let things play out. I like to capture profit. And the reason why I like to trail this is I would rather get out of a trade and get wicked out with $6 or $7 of profit than suddenly a massive displacement candle and it takes out my complete stop loss. Yeah. Okay. But there's also, if you just want to do lottos and feel comfortable with it, there's nothing wrong with that either. It's really kind of a personal individual preference. Okay. So that's what we call the 8 pullback. You could also do it on the 20. However, when you do it on the 20, it's always better, again, to get a confirmation candle, just like on the 8. You can wait for it to touch the 8, to touch the 20. But you could take it there, and that's risky because you're not getting confirmation. It could reverse. But if you get in at that point, it's a good entry because you're right on the EMA, especially if it reverses, or especially if you get a confirmation candle. But if you feel more comfortable just waiting for the confirmation candle, you can do that as well. Okay. So that's the pullback on the 8 and on the 20. Now, the next one that presents itself is what we call a reversal pattern. And this kind of ties into candlesticks, which we spoke about earlier. And to be honest with you guys, this is tricky. It's tricky to trade because, if you look at a situation like this, here's almost like it's not quite a doji, but it has doji-like features. And then look at this candle right here, massive bullish candle. And when I mean massive, there's displacement on it. And the candle got pushed all the way up to here for closing. So, well, what are you going to do here? Well, what you could do here next is you could wait for the next candle here. And if this candle is developing and it's bullish, you could get in right here and you could place your stop loss right down here. And then you could target maybe VWAP and let this, or even a level and let this right up. Now, the only problem with this is that there's quite there's a lot of risk here. And when I mean a lot of risk, if you just look at the price here, 644.4 down to, I think that's 643.7 or whatever it is. But yeah, I mean, that's like 0.70, 0.80. And again, if you're using an at-the-money call, and assuming all things being equal, that this is 50 cents, that's, $35 of risk. And again, this is a trade that you're just going to put on and you're going to leave it alone and let it play out. Okay. However, if this trade is playing itself out and it suddenly presents itself in profit, again, you want to be trailing this. There's an indicator that I use on the 5-minute. It's called an ATR trailing stop. And I've been playing around with this lately. And there's a level that I found And there's a guy from S&B Capital. It's a YouTube channel, phenomenal YouTube channel. It's a prop firm, prop firm, I think down in Manhattan. And one of the traders down there, he uses the 5, and I think he uses the 2 minute as well. But he uses this ATR trailing stop, and this ATR trailing stop, it has a setting of 3 and a factor of 1 on the 5 minute chart. And what's the significance of this? Well, the significance of doing this is once you're in a trade and the trade is moving, the ATR trailing stop will kind of give you an indication as to where you should be putting your trail. So, if you're in the active trader and you have, the trading ladder in the center, you have your option graph on the left, and then you've your price action SPY on the right. So you've got your 3 views right there, and they're concurrent next to each other, left to right. Well, as you see price action moving in your favor, this little trailing stop, you can basically set it up like a little dot, and as the candle closes, it will move up the trailing stop to a level that it's suggesting that you move up your trailing stop to coincide with that. So this is something I've been playing around with, and I'm happy to share the settings on that. Okay, so this is a reversal trade, and this is super tricky, super tricky to do. But if you catch it and you feel comfortable with it, I mean, look at this candle here. This candle was an engulfing candle, yeah, and it blasted through all the EMAs as well too. Okay, so that's that. And then the last one is, I didn't even know if I was going to talk about this today. This is what we call a crossover scalp. And what a crossover scalp is where, based upon what chart you're on, the 2 minute, the 3 minute, the 5 minute, you're looking at EMAs to cross. So let's say, for example, you have a bullish trend. And with a bullish trend, what you're looking for is you're looking for the 8 EMA to cross over VWAP. Excuse me, I'm sorry, you're looking for the 8 to cross over the 20. So that's the important first thing is you want to see that 8 bow up, and you want to see it cross over the 20. So now you have a positive slope or a positive DYDX. That's the first thing. Second thing then is you're looking for the 8 EMA, especially for below VWAP. Remember, guys, with VWAP, if price action is below VWAP, you're bearish. And if price action is above VWAP, you're bullish. That's kind of the general theory, at least. So if the 8 crosses above the 20, the next thing you're looking for is the 8 crossing over the VWAP. Now, if the 8 crosses above the VWAP, okay, this is interesting. Now we have possibly a bullish thesis in play. But if you see the 20 crossing over VWAP as well, now this is something that you probably want to look at. And again, if this is moving kind of vertically up with kind of a pretty strong slope, maybe this is something that you want to take. But if it could be encapsulated between a level of support and a level of resistance that's tight, maybe you could be in a squeeze channel here. So this is why this is tricky to take. And then, of course, the converse holds true as well, too. So I believe I might have one of these two to show you. I do, yeah. So with this one right here, so again, in purple, we have the 8. In blue, we have the 20. And in white, we have VWAP. So this is the first trigger here. This is the crossover. But you notice here that we're still above VWAP. Okay. Now, the second thing to happen is that the purple, which is the 8, has now crossed over VWAP. So the 8 crosses below the 20, and now the 8 crosses below VWAP. And then the next thing to happen is that the 20 crosses below VWAP as well, too. So now, this is, I believe they call this a Death Star, if I'm not mistaken. But you now have a bearish kind of play that's set itself up. But do you notice here we have a level that's been marked? So it's almost like you got to be cautious here. But one thing I'm looking for down here, guys, is volume. What's going on with the volume? Because if the volume is rising here, then maybe this is something that I could take. Now, where do you take it? Well, that's a great question. You could take it maybe on a pullback. And again, you could have a stop loss just slightly above that support level. And again, where are you going to do your target? You could do your target. This here happens to be a trend line. Okay. And again, the only issue with this on a 5 minute is it's taking time to develop. And sometimes it presents itself maybe later in the morning, and I'm not interested in it. Or it could present itself like, if you look here in the afternoon, it presented itself again. So this was the crossover on the way up. So it crossed, the A crossed over the 20. And then look again, the A crossed over VWAP. And then look again, the 20 crossed above VWAP. So again, everything is aligned. And notice that this slope is a lot more pronounced than this slope right here. However, volume, guys, you got to go down to the volume. What are you noticing with the volume? It's decreasing. It's decreasing. Over here, it was increasing. So this is actually supportive of a bearish play. The volume is telling you everything here, that even though this is crossed over, the volume is saying maybe this is not going to work out. And, you know, if you're in so you have a bullish thesis right here, and as you can see, it actually came down, it retested at a support area, and then it continued again. So again, these are tricky to do, but you want to be using these in volume, and you know, it's just something I have to do a lot more research on, but I figured I'd just mention that. Again, these last two, the crossover and the reversal, I try to stay away from these, but they could present themselves. And what do I mean by that? Let's say you have like a day like Friday where there's a massive dump and there's a huge displacement of like 6 or 7 on the SPY. You know, extends the or it's greater than the average true range of like the last 14 days. Okay, the average true range is a very important metric. And now you're actually kind of getting an indication for a reversal. Well, if you kind of see like a pattern like this presenting itself, that might be an opportunity to get in and maybe ride some of the wave back up. Okay, so that's why I figured I'd mention that. Okay, so just to kind of go over the chart setting again, it's the 5 minute that I use, the 80 EMA is in purple, the 20 EMA is in teal, and the VWAP is in white. And this ATR trailing stop, I've started to kind of use this. And the settings for the ATR period are 3, which means it goes back 3 periods and a factor of 1. And again, why am I using this? Because if I'm in like a lotto or I'm in like a break and retest with some targets and things are moving, then if I'm trying to figure out, well, where am I going to place my trailing stop? This is kind of telling me where I could place my trailing stop. There's 2 other indicators that I use. One's called a Marzi 2 momentum, and there's another one called a stochastic, and these are phenomenal indicators. There was a guy on Reddit, I'm trying to remember his name. He developed the algos for these, and they're basically they're momentum indicators, and they use RSI, they use moving averages, and they use Fibonacci to kind of give you an idea if you have something in play. You have a bullish momentum or bearish momentum. The stochastics as well kind of give you an indication if stuff is overbought. So there's a fast stochastic and there's a slow stochastic. And you know, if you're at the top of the range and you see both of those flag for possibly a reversal, then maybe the trend is exhausted. Okay.
Hey, Ian, I'll be right back. I gotta say goodnight to my kids. Okay.
Got it, Lance. So these were some of the trades that I took on Friday, just to kind of give you an idea what I was doing. So 172, 179, I think was one scalp. Another one, I saw it, didn't like what happened, and I just decided to cut it. And again, this is just super fast. Another one, 142, 148, another scalp. This one here, 147, 165. That happened super fast. Another one here, 132, 141, 176, 180. And then this was around, yeah, this was around the just before Phil's alert at 10:30. I decided to preempt that because I was liking what I saw. So I just got in and I did a double target on this, and that went 191 to 203 and 191 to 210. But then I had a loss here. It was second loss actually, because there was 145, 142. This one went 171 to 144. And when I looked at this in retrospect, why did this happen? This happened because I didn't follow my rules. And that was a trade that I was really mad about because I was on a run here. Now, this doesn't always happen. Today I actually started well and then crapped out later in the morning. Actually had a loss on the day. But when I always post-mortem my trades. And in this particular instance, I was like, what the hell did I do taking this trade? There was no logic behind it. But anyways, those things happen. Don't beat yourself up. But it's really important, guys, when you're doing these when you're doing a post-mortem on your day trading, you got to go back and you got to say, okay, I made the right decision. And even if the outcome was didn't work in your favor, then that's okay. you made the right decision. It just went against you. But if you're entering not based on logic, but based on FOMO or nonsense, that's not good. That's gambling. And we're not here to gamble. We're here to try to make high probability trades. Okay. So this kind of gives you my layout in Active Trader. So here in Active Trader, I have my options chart on the left. I have my ladder here in the middle, and then I have my SPY chart over here. And basically, I have a watch list here where, you know, whatever option I'm looking at, if it's a call or a put, I'm toggling those, and those seamlessly go right into the trading ladder. So if I see something I want to act on it quickly, boom, select it in the watch list, gets filled in here, it gets in here. One thing I would caution you guys is make sure if you're using Active Trader on TOS, that if you have your template set up, just double check that everything is looking okay, because sometimes these can be a little quirky. So I always like to double check them in the morning before I'm trading. Okay, so that's the Thinkorswim setup. And then what are my rules? Well, the process again is the daily, the 4 hour, and the 1 hour. Fill them in with context, and then down to the 15-minute, and you're repeating this. And then, so that's the context. And then the inferences are where we're doing logical trades. Again, at breakouts, a squeeze breakout, break and retest, EMA pullbacks. Those are the ones I look at. And then the other ones are like the reversals and the crossovers. Not the biggest fan of those. So remember, the closer the entry is to the level of the EMA, the better it is, especially from a risk reward perspective. And you're always looking for optimized entries. So if you're doing a breakout, you want to do it with momentum above a certain level or below a certain level. If you're doing a break and retest, you want it to come back and touch, and then you want to get a confirming candle, and you want to, you could wait for the confirming candle to close, or if your kind of spidey senses are telling you that you're getting that candle, you can get in straight away. That's a better entry. And stop loss just a little below, and then a target, maybe previous high day or previous low day or something like that. So you're always looking for optimized entries. Okay. Now, when profitable, now I'm kind of repeating myself here, but when profitable, you want to consider trailing. And if you get wicked out, then it's better to get wicked out with a profit than a full stop loss reversal. That happened to me today. I got displaced on one trade, and I was like, am I going to leave it or leave it? And boom, boom, got stopped out. Okay,
Yeah,
so
I'm a big fan of trailing stops in general, just because if you're already at a profit, and I'm trying to teach chemistry kids and whatnot, it's a little hard looking at the market during it. So if you're at a profit, make a trailing stop where if it happens to reverse immediately after, you might still get out of a slight gain. I don't know, Aiden, you do that as well sometimes. But if it just happens to keep running, then you're in great shape. And you don't even have to do anything, you just let it be.
yeah, and careful on the number of trades that you're taking, guys. You don't want to be doing a crazy number of trades every day. That's gambling. That's gambling. You should, if you're doing this before the alert at 10:30 a.m. in the morning and you only take 1 or 2 trades, that's okay. Hey, if you take no trades, that's okay as well. No trades is better than bad trades. And what do I mean by that? If there is no setup that's presenting itself, like, pretty much this morning, there really was nothing going on before 10:30 a.m. before Phil's alert this morning. I took one scalp because I was a little bored, and I probably shouldn't have done that. And again, it worked out a little for me. I caught a little bit of the wick, but again, there was nothing going on, and you don't want to be trading chop. Because if you trade chop, you're going to get caught in the middle, and it's going to pull your hair out. So basically, watch the number of trades, and no over trading, and moreover, no revenge trading. If you've had 2 or 3 trades and they're all losses, that's it. Close your computer, you're done for the day. Look at Phil's trade at 10:30 a.m. Look at Lance's at 10 a.m. If you're in those, you can look at those. But if you're doing any type of day trading and you've had like 3 losses, that's it. Cut it. Cut it, cut it, cut it. Because you want to be trading with conviction, and you want to be trading with results. So if you do a scalp here and you do a scalp there, and both of those are winners, it gives you that level of confidence. But if you get another trade and a trade after that where you got stop lossed out, now that nullifies the first 2 trades, and now maybe you've got a loss. Okay, so again, psychology is so important here. No over trading, no revenge trading. And also, usually I'm done like around 11 a.m. unless, for example, I have a credit spread on. I'm hoping that doesn't go beyond 12. Doesn't go beyond 1, because I like to have a little nap later in the morning, because I work usually in the afternoon and at night. So 9:30 to 11 a.m. is ideal for me. And if I've got my SPX trades on, then hopefully noon or 1 o'clock. Keep track of your emotions while you're doing this, and journal everything. So all the trades that you did, the horrible trades that you did, if they didn't have any logic behind them, write down in your journal, what the hell was I doing taking this trade? There was no logic, there was no order to it. And guys, if there's no logic and there's no order and there's no structure, what the hell are you doing taking the trade? You have to be taking trades based on, something. Now, do these always work? No. I mean, again, there's no certainties, there's only probabilities. But the reason why I use scalps like this and I use like break and retest and EMA pullbacks is because other traders use them. And, when they're looking for entries, this is what they're doing. Okay. And, become a chart nerd. What I mean by that, watch lots of stuff on YouTube, read lots of books. Lance recommended a book on the Discord. John Murphy's book is another good book. The Candlestick book that Lance mentioned earlier. Read as much about charts that you can, because the more you read, the more you become informed, and watch as much educational content as possible. And don't be hard on yourself. Like, for example, I had Thursday and Friday were good days for me. Today was a bad day for me. And then, when I finally got out of it and I kind of did a post-mortem, I realized, you know what, this whole bloody thing was consolidating all day. And I should have just gone right back up to the 15-minute and I would have seen that. But again, I was caught in my little bubble on the 5-minute. So, this is the power of the levels, the 5 to the 15 to the 1 hour to the 4 hour to the daily, is they all tell a story. And it's almost like at the high level, you've got a fractal. And at the low level, the micro level, you also have a fractal. And you kind of want everything, almost like a jigsaw. You want everything to kind of like fit together. And that's easier said than done. But that's the whole point of the levels, is sometimes if you're unsure, like if you're down at the 15 at the 5 and it's consolidating, go back up to the 1 hour and see what the heck is it doing on the 1 hour. Maybe in the 1 hour it's actually consolidating. And what's happening on the 15 and the 5 is just reflecting what's happening on the 1 hour. So look at the different chart levels, and they'll kind of guide you as to what you should be doing. And trade a biased direction. Chop suey, guys, chop suey. So when you're breaking out a range and you have something that's got good aura vol and you've got something that's got directional bias, that's what you want to be trading. QQQ. I'm actually kind of sorry in retrospect that I didn't trade QQQ today. I did point it out in the Discord that QQQ was moving, and it was moving because I think Robin Hood was moving. There was a lot of stocks moving today, and SPY. That's the thing that really kind of like sometimes QQQ can move in one direction, and SPY can almost like diverge. It can consolidate, or it can actually move in the other direction, and it's almost like a confounding variable. You would expect both of them to move in concert with each other, but sometimes they don't. And that's a clue. When they don't, when QQQ and SPY are not moving in tandem with each other, yeah, that's kind of interesting. I'm looking for correlation. And if they're both moving, if they're both dancing together, that makes me feel better. Then I can go for the 5 to the 15 to the 1 hour and see if there's a story developing. But again, when you're trading real time, sometimes it's hard to see that. But again, experience, when you post mortem after the fact and you go back and you look at it, it kind of gives you a better idea. And the last thing I'll mention here is what the hell is going on with Mondays, guys? It's always chopping. I don't know. What's Lance, got any ideas?
Um, there's almost never any economic news on a Monday. I mean, it's typically middle of the week, like PPI, CPI is coming up this week. That might be part of it. It's hard to say.
Yeah. Anyways, Monday. But anyways, that's my presentation.
All right, Aiden, that was a great job. Very detailed. A few things that I'd recommend, especially if you're relatively new to this or know a little bit about it, is replay this video a few times. And then I would try to recommend doing one strategy and really dive into that. Do quite a bit of paper trades first, and maybe even one contract of real money, which won't necessarily break the bank. Um, Journal everything that you see. So if you see, say, an opening range breakout, and then you decide to take a trade, take a screenshot of your chart and then describe why you took that trade. I entered because it hit the opening range breakout. I put my stop loss, right where the breakout began, and I took my take profit somewhere. So actually being able to describe what you're doing in your trades will help in the future. And eventually, if you do a few different strategies, maybe you're just better at one over the other. So then just try to focus on those. And when you see the actual candles do what you're better at, I would say probably do those more.
And that's such a great point because the two type of trades that I like are the breakout trades and the break and retest trades and the EMA pullback trades. The others I don't really care for all that much. So that's such a good point that you made, Lance.
Right. I've tried most of these trades a lot on paper. Occasionally I'll do one contract on stuff for the last few years or so. And I guess me personally, one of my best is if you hit a multiple support levels and then you see it hit another time, you try to play the reversal. Um, so like let's say it's going down, up, down, up, down. So it's hitting that support level multiple times. If it hits it another time, I usually just try to play a call in that case to see if it reverses up.
Yeah.
Although
Friday was
sometimes you got to
fr
be very patient with those.
yeah, I was going to say Friday was an awesome day. Because it flushed down so fast. And not only that, but real time in the Discord, it was flushing through the levels. And
Yeah.
when it flushes through the levels have such a high when you're blowing through when you're blowing through a level, that's more important. And also when you're blowing through a 4 hour trend line. These are things that you want to watch. And what was interesting about Friday was the momentum, Lance, how quickly. And not only that, but the put options were the volatility. Did you guys notice that on Friday? The volatility on the put options. These things were moving like super, super fast. Yeah.
Yeah, I didn't notice it because I was working, but I did notice that the premium levels were very high. So
Ooh.
that must have been the volatility and the actual price movement. If you're relatively new, the And Culture book is probably the one I'd recommend with first, because it talks a lot about what each individual candle means, and then it looks at combinations of a few candles, and then they talk about the volume and how it might support what's happening with the candles too. Um, and then going along with that, just a basic thing on support resistance levels and tying into that. I think that's a good place to start if you're relatively new to this stuff. Um, you've been doing more of these trades than I have in general, but I guess that's a few things that I would consider.
Yeah. One other thing I would add as well too is the credit spreads on SPX are also a wonderful strategy to do. And the day trading, I could start my day at 9:30 and not take any trades before 10:30 a.m. and then look at Phil's trade and maybe there's a trade, take that.
Right.
Or I could take Lance's trade at 10 a.m. if I feel that that's the trade that I'm in. So I have an XPX trade going on, and then maybe I'll take a couple of scalping opportunities. So I guess the point that I'm trying to say is this is just not the only thing that I do. You can have a multifaceted strategy, and iron condors and SPX, put credit spreads on SPX, call credit spreads on SPX. You can use those to complement this. Yeah.
Sure. A lot of the things that you're talking about is with buying options. If you want, you could do the exact same strategies and then just play the opposite side selling the option. So instead of buying a call, you could sell a put. And then what's interesting is you can make the probabilities a little bit more in your favor if you want to. Like, let's say that we're bullish after looking at momentum, for instance, you could sell a put at a low delta. And then even if you're wrong on the direction where it reverses, you still might be okay in the end just because you were pretty far away from the current price.
And when you sell options, when you sell credit spreads on SPX, the time decay is in your favor
Sure.
versus when you're buying options. And that's a big one as well. I actually, one thing I've been looking at with SPX credit spreads is the 15-minute chart instead of the 5-minute chart. Not that there's any kind of material difference between the two, but to Lance's point, yeah, I mean, you can take these strategies here and actually instead of using at the money calls and at the money puts, you can use credit spreads in lieu of that. Yeah, over
Right.
over a long period.
One
Yeah.
thing to consider doing that stuff is how much you're actually using in your account compared to what your total account size is. So if you're doing a simple buying a call or buying a put, you could easily set it up where there's very little buying power. If you're selling a credit spread, you typically need more buying power on it. So just be aware of that. If you're selling like a 10 with credit spread, you need $1,000 minus the credit you take in. So that could be $950 in many cases. But if you want to do it with a smaller account size, you could just buy a call, buy a put. It might only be a few $100s in the end.
Yeah.
Any questions from any of the members that are still here? You can write it on the chat or just type it, or just unmute. Erwin, do you have any questions from what we've seen so far? All right. Eden, any other final thoughts then, I guess?
Um, Psychology, Lance,
Sure.
mindset, don't and risk. It's anybody that's doing this, just keep your risk in check and start small. Start with one contract and get comfortable. And as far as frequency is concerned, start with a low frequency. And what do I mean by that? So, if you're taking scalps in the morning, one or two,
Sure.
start and do it based on conviction and based on these type of strategies that I was saying. And then what will happen is over time, you'll start to get a little more confident. And if you're doing the journaling, and you're tracking everything that you're doing, um, especially the trades that went wrong, and you're learning what went wrong. It's like a cleanse and repeat, where it's like a kid learning how to ride a bicycle. They fall down, they get back up. Maybe they have stabilizers. They're riding with the stabilizers for a period of time. Then you take off the stabilizers, and hey, we've all been there, Lance, right? I'm sure you have
Sure.
with your kids, me
Oh,
with my
yeah.
son. And you're holding you're holding the bike for a period of time, and then eventually the kid can cycle the bike on their own. And again, this doesn't happen overnight. This takes time.
Oh, yeah.
But every day, guys, just watch just say, hey, I don't want to lose more than $50. I don't want to lose more than 100. But whatever your threshold is, stick to that. And when you have a winning day, um, just reflect on it and say, you know what? I had a winning day today. And why did I have a winning day? Because I took good trades that were based on good setups with good probability. I had an optimized entry and reached my target, or I grabbed a good scalp. And don't beat yourself up. If the scalp that you grabbed was $10, $12 or $8 versus, maybe it could have been $20. Well, hey, you know what? I'll take a scalp that gives me $7, $8 versus like 15, 16, versus getting reversed out and hitting my stop loss. So that's the trailing is important. Yeah, so that would be my advice with regard to this.
Once you think you're relatively competent and pretty confident in a certain strategy, is there a certain percent of your account you're willing to risk?
So usually, every day when I go in, I basically have two accounts. I have a margin account um, that I use to trade my credit spreads on SPX, and then I have a cash account. And with the cash account, I'm typically maybe 5% of it that I might have 3 to 5% that I'm willing to play with every day, you know. And but usually, there's a certain threshold that I have, and if I hit that threshold, that's it. As far as a loss, that's it. I'm done.
Yeah.
Yeah, so it's really important. It's really important, guys, that you view this as a long game, meaning that in order to stay in the game, you have to have liquidity or you have to have capital. And you kind of have to be you have to protect your capital, and you protect your capital how? By not over trading, by taking high conviction trades, and by journaling everything and like a cleanse and repeat. And some days we could be in the room, and if you don't take any trade, then so be it. If maybe there wasn't any setup, and guess what? That was the best trade that you took. No trade at all.
Yeah.
Yeah.
Do you typically have stop losses based on what's happening with the chart, or is it based on the percent of your account that you have?
So when I enter a scalp, so I have scalps and SPY. Um, Usually, like I'll have a stop loss maybe 25% below, and I'll have a target of maybe 25% above. Now it's very situational, Lance, on what the at the money is trading at.
Sure.
So you know, like for example, the VIX today was whatever it was low, it was about 15 or change, and the IV was low as well, whatever it was, 14, 15%, I can't remember.
Yeah, I was really
So yeah, so let's say for example, an at the money caller put is I don't know, $100. We'll just do a round figure on that. If I'm looking for a breakout scalp, you know, it might be like 25% above, 25% below. So 125 target, 75 stop loss. However, I want to get in. When I see something that's happened, I want to get in. And then I'm moving the sliders as quickly as possible to, in my mind's eye, where I want to place that stop loss. So for example, if we have a breakout scalp and I want the stop loss to be slightly below the breakout channel, so maybe like a third down or something, I'm going to move that up as quickly as possible. But at the same time, if there's a momentum move with velocity and acceleration, and I see that move, I'm grabbing it. I'm grabbing it with the target. If I have my target and it's up at 25, and let's say I got in at one or like $100, and it's moved to like 112, 113, boom, I'm grabbing that. I'm grabbing that. I would rather grab some scalp than no scalp at all, you know. But that's just me. I mean, you know, there was a trade that I took this morning. I think it was I just grabbed the end wick of a bearish candle, and you know, it was only like $5 or whatever. But again, I'm doing this so fast, guys, in real time. I'm looking at the charts, I'm looking at the velocity, I'm looking at the momentum, and it's like my eyes are moving everywhere, and I'm responding to this in real time. And this is not easy. This can stress out a lot of people. I mean, you kind of have to have hand-eye coordination, like super fast here. And also, if something is going against you and your spidey senses, again, the analogy I would give you is if you're driving in a car and everything is looking good, and suddenly a deer comes across the road, boom. It's the same type of like instinctual reaction that you have to yeah. So that's like with scalps. With the break and retest, that's a more kind of that's a less stressful trade. The break and retest is a less stressful trade because you've got a confirmation, and now you just move your stop loss to slightly below, maybe one third of the level below, and then you have your target, and then you can kind of let it play out. But as it's playing out, again, I'm trailing. You know, as soon as that ATR trailing stop lens is telling me that this is where I need, whatever the indicator is telling me to do, it takes that decision out of my control. I'm just going to follow what the indicator, what the logic is. So that to me is a great indicator, because if you're in a profitable trade, you can move up your stop loss, or you can trail it to whatever the ATR indicator is telling you to do. Yeah.
Yep, makes a lot of sense.
Yeah.
All right, I think we're about to end it. We're at an hour and a half already.
Oh God, I'm sorry, guys. I'm sorry.
No, it's okay. This was really detailed. It's like a master class in technical analysis. So thanks a lot, Aiden, for all your help and support. And definitely like seeing all your channels, postings and whatnot. Usually I don't have time to look at everything you're writing, but definitely appreciate all the support you're giving on your
All
channel.
right. You got it, guys. Thanks so much. Thanks for attending tonight.